Okay, let's dive right in. The entire financial system, the world of money, it's not just something that happens to us. It's a game. And like any game, it's got rules, it's got players, and it has hidden mechanics. Here's the thing. If you don't learn the rules, you're not just playing to lose. You're getting played without even knowing you're in the game. So think of this as your player's handbook.
We have all been there, right? You see that paycheck notification for, say, $2,000, and for a split second, you feel great. But then you actually look at your bank account, and a huge chunk of it is just gone. Where'd it go? Who took it? And why? Well, that's the very first rule of the game we need to get our heads around.
So before we can even talk about strategy or how to win, we have to understand the board we're all playing on. And that board is money itself. So what is it, really? The answer might actually surprise you.
I mean, just look at how simple this is. What is the actual physical difference between a dollar bill and, I don't know, a stick you find on the ground? Not a whole lot. The only reason that piece of paper can buy you a coffee and the stick can't is because all of us as a society have collectively agreed that the paper has value. That's it. It's a giant multiplayer game that's built entirely on a shared belief. So at the end of the day, money is just a tool. It's a social construct. You've got governments printing it and central banks regulating the supply to get the balance just right. Because if they print way too much, our money suddenly becomes worthless, kind of like monopoly money. And if there's too little, the entire economy can just grind to a halt. It's this incredibly delicate dance that's built on nothing more than trust. All right, so we get the game board now. Let's build on that and introduce the main rules and the biggest players you're going to encounter: taxes and banks. These are the non-negotiable parts of the game. They affect absolutely everyone.
And here we go. This shows you exactly where that missing chunk of your paycheck goes before you ever see a single dime. The government takes its share. We're talking federal and state taxes, plus Social Security and Medicare. Now, it can feel super frustrating, but this is what they call the cost of civilization. You know, it's what pays for the roads, the schools, and all the public services we depend on.
And yeah, the government doesn't just take a bite out of your paycheck, it gets a piece of the action at almost every single stage. You've got income tax on what you earn, sales tax on what you spend, and capital gains tax on any money your investments make. Social Security is basically a forced retirement savings account, and Medicare is a health insurance program for seniors. Okay, now for the other major player, banks. You know, most of us picture a bank as this giant, super secure vault where our money just sits patiently waiting for us. That could not be further from the truth. The reality is, your money is already out the door. Banks are more like middlemen or financial matchmakers. So here's the secret sauce. It's called fractional reserve banking. Let's just walk through it. You go and deposit your $1,000. The bank is legally required to keep only a tiny fraction of that on hand, let's say $100. So what happens to the other 900? Well, they immediately lend it out to somebody else who wants to buy a car or start a business. And then the bank makes money on the interest from that loan. The whole system is built on one big assumption, that we're not all going to show up at the exact same time demanding our cash back. Okay, so we've covered the board and the main players, but there are these invisible forces that are constantly at play, kind of like the game's physics. We're talking about inflation and interest, and trust me, they can either make you or break you. I absolutely love this analogy because it's so perfect, right? You paid for a full bag, but you feel like you got less than you expected. That is inflation in a nutshell. It's that feeling of just getting less for your money than you used to. So here's the really important thing to understand. Inflation doesn't change the number on your money. A $5 bill is still a $5 bill, but what it can buy, its purchasing power, is what slowly gets eroded over time. It's like this quiet thief that steals the value of your savings if you just let your money sit there. And then you've got interest, the ultimate double-edged sword. When you're paying it, say on credit card debt, it's a relentless enemy. It can turn a small purchase into this massive financial burden. But when you're earning it on your savings or investments, well, then it becomes your best employee, working 24/7 to make you more money without you lifting a finger. It all comes down to who's collecting it. All right, let's make this personal now. In this game of money, every single player has a score. It follows you everywhere, and it pretty much determines the kind of moves you're allowed to make. We're talking about your credit score. It's this 3-digit number, usually somewhere between 300 and 850. And it's not a measure of how rich you are, it's a measure of how trustworthy you are. Lenders use the score to decide one really simple thing. If we lend this person money, are they going to pay us back? A high score opens doors, a low one slams them shut. So how is this all-important number even calculated? Well, it pretty much boils down to these 5 factors right here. Payment history is the biggest piece of the pie by far. It's just, do you pay your bills on time? Then you have how much you owe, how long you've had your credit accounts, the different types of credit you have, and how often you're asking for new credit. It's not just about being good with money, it's about looking good to lenders.
Okay, we've learned the rules, we know the players, and we know how we're being scored. So how do you actually win this game? The answer isn't about getting lucky or finding some secret shortcut. The winning strategy comes down to 2 simple things: investing and time. Think about it. Most of us trade our time for money. You work an hour, you get paid for an hour. Investing completely flips that script. It's when you trade your money for more money. It's the single best way to fight back against that silent thief, inflation, and actually make your money grow instead of shrink. And there are a ton of ways to do it. You can buy stocks, which are just tiny pieces of ownership in a company. You could buy bonds, which are basically loans you make to a government or a corporation in exchange for interest. You can invest in real estate or buy funds, which are like prepackaged baskets of these things to spread out your risk. And this is the secret weapon of investing. It's called compounding. This is when your investments earn money, and then that new money also starts earning its own money. It's like your money starts making clones of itself. This is the real cheat code to building wealth. And this just brilliantly illustrates the most important ingredient of all: time. In the first few years, yeah, it feels really slow. But as you can see, after 20 or 30 years, that growth becomes absolutely explosive. And this is why starting early is so much more important than having a lot of money to begin with. The whole system is designed to reward patience. And I really want to leave you with this thought. Yeah, investing has risks. Of course it does. Markets go up, markets go down. But the guaranteed loss, that comes from doing nothing. The real danger is letting your money sit there while inflation just eats away at its value, quietly stealing your financial future year after year. Winning the game of money isn't some overnight event. It doesn't happen in days or weeks. It's a long-term strategy, and it's built over decades with discipline and with patience. You now know the rules of the game. So the only question left is, what are you going to do with your decades?